Pace of U.S. inflation actually accelerated in August, but does that mean anything when it comes to a Fed rate decision and an expectation of a cut? Widely expected. Joining us now to discuss is Alex Gorwitz, VP Director and Portfolio Manager for Active Fixed Income at TD Asset Management. Alex, welcome back to the program.
Thanks, Greg. Great to be here.
So we did get that print today, and I mean, it was within expectations, but it is a move higher. I think the highest inflation's been in the states on a headline basis since January, right before a Fed decision. How does this all go into the calculus? What's your take on the CPI number?
So when we look at the month-over-month print, which came in somewhere between 0.3 to 0.4% month over month, or the annual print, whether we're talking about headline or core inflation, anywhere between 2.9 to 3.1%. Those numbers, not only are they broadly in line with expectations from market strategists or market pundits, but also reinforce the pass-through to PCE, which is the inflation metric that the Fed cares about, is going to be plus or minus in line with their expectations. And part of that is a combination of some, we'll call it one-off surprises. For example, food popped higher month over month, unlike prior months where it was a lot more benign or even a drag. Whereas some tariff-related price pressures are continuing or even firming up further, for example, new or used cars. But nothing sort of material or standout that would worry the Fed that the way inflation is materializing deviates from their forecast.
So nothing to worry the Fed on inflation. We did get, though, weekly jobless claims, and I believe that they're at their highest in quite a period, too. Of course, they have a dual mandate. So when we take a look at the state of the U.S. labor market right now, particularly after the Jobs Friday report, there seems to be signs of caution.
Correct. And that's what ultimately the market reacted to a lot more. There was actually a tiny delay in that claims data release right after CPI. So on CPI, if we looked at the bond market, it was neither here nor there. And then as soon as that claims data came out, we saw bond yields fall across the yield curve in the US and actually Canada as well, but more of a move in sympathy. On claims data or the jobs picture in general, today's data probably comes with a little bit of an asterisk in that, the floods, the unfortunate floods that hit Texas, that happened in Texas in the last couple of months. There was a deadline at the beginning of September to apply for effectively disaster relief, if you will. So you did see a tick up in claims, particularly in Texas. The question is, how does that persist over the next couple of weeks? So the market will be watching that closely. But then to your point about Friday's jobs data, we've seen whether it's been through revisions, which is what we had on Friday, or whether it's been through just sort of the broader trend in the last couple of months, more softening than expected. I wouldn't call them cracks. I wouldn't call them a collapse, but certainly a lot more softening than expected in the labor picture.
So the Fed has this inflation report. It has this picture of the labor market. It walks into that two-day meeting next week with all those documents under the show. What do they make of it all? What happens around that table?
So when I think about the Fed, there are a couple of things to note for next week. Because it is the September meeting, we will get their updated forecasts. And that's important because that also comes with updated dot plots. So what are they thinking about where monetary policy will go for the next several meetings in the next several years. So what the expectation right now from the market is relative to their last dot plot, which was in June and showed 2 rate cuts to the end of the year, I think the market has moved towards expecting 3 rate cuts. In other words, September, October, December, from the market's point of view, will all be rate cuts from the Fed. We'll see if the Fed actually matches market expectations, but history tells us that they probably will. That's generally what happens, right? The market moves in a direction and the Fed tends to follow suit. But also just looking at the commentary or the concerns from some of the Fed members, particularly around the labor picture, that those concerns seem to be validated by, again, the weaker than expected data points. What this means to me is that there is risk that it won't just be 1 or 2 Fed members that might dissent for a 50 basis point rate cut. You could end up getting maybe 3 or 4. If you get more than 2, I don't think the bond market is expecting that, and it would move towards lower bond yields than what we've currently seen.
Could you justify a 50 in this environment?
Not from the data that we've seen, not in my opinion anyway. Where I do see a lot more conviction, and again, it's really just in line with what the bond market is saying, is a 25 basis point rate cut at each of the last 3 meetings. So next week and then October and December. But if we see more dissents or some level of dissent towards a 50 cut in September, I think you would see a pretty strong bond market reaction.
Yeah, let's take it to the bond market reaction. Ultimately, what all this means for the fixed income investor. What does it mean?
It means that the market has correctly reacted to the softening of the labor data. Again, inflation-related data, whether we're talking about PPI, CPI, even the expected PCE that we're going to get in the next couple of weeks, all of the inflation level data is showing tariff-related price pressures, but not egregious ones. So they're coming in line with expectations. Whereas what is missing expectations is the labor side, right? It's the jobs data. It's the picture around the job market that is going to, or that is expected to put the Fed on a more dovish path. The market has already moved in that direction, but again, any sort of additional dovishness relative to that market expectation should see rates continue their more recent trend over the last 1 to 2 months, which is towards lower bond yields.